Have you ever wondered why the traditional American dream, the steady job, the house, that stable retirement, why it now feels, well, completely out of reach for so many people?
It's a really common feeling, isn't it?
Yeah. We often talk about the economy, buzzwords fly around, but today we want to go a bit deeper. We've looked at some analyses suggesting that the very operating system, American capitalism itself, might be, well, fundamentally malfunctioning.
It's a really critical question to ask right now. And our aim here is to explore these shifts,
Yeah.
looking at everything from flat wages and this crushing debt people face,
Right.
all the way to the incredible concentration of wealth you see at the very top.
Yeah.
We need to understand the history, the mechanics, how this engine that seemed to power global growth started maybe breaking down, and what that actually means for you listening today.
Okay, let's unpack this then, starting right at the core. We all use the word capitalism, right? But beyond just like private ownership in a textbook, what's the mechanism? What makes it tick and, supposedly drives its success?
The mechanism is absolutely crucial. See, capitalism is built on this idea that resources, what we call capital, so equipment, buildings, raw materials, even labor, it's all privately owned.
Okay.
And it's constantly reinvested to fuel growth. The whole point is this relentless drive for efficiency, for scaling up production.
And that scaling idea, that's where the dynamic for the worker changes completely, isn't it? Moving away from, say, the individual craftsman.
Exactly. Think about a skilled cobbler back in the day. They controlled everything, sourcing leather, making the boot, selling it. They captured all the value from that pair of boots.
Right, they own the whole process.
Now, contrast that with a capitalist funding a factory. They hire lots of specialized workers. One person just cuts leather, another runs a machine, someone else handles shipping.
Specialization.
Yeah, and that specialization means faster, cheaper production. It gives consumers way more choice. But, and this is the crucial part, the individual worker loses that control, that agency. They only make one small part of the product.
And get paid just for that part.
Precisely. While the investor, the owner, captures the huge benefits from producing at scale.
And since that owner, the capitalist, needs constant profit growth, they basically have three main ways to boost it, right? They can squeeze wages, cut corners on quality, maybe use cheaper materials,
Or,
or just charge the consumer a really high price.
exactly, which, opens the door to potential exploitation. Big time.
But the theory of capitalism, it has a built-in check for that, doesn't it?
It's supposed to. Adam Smith's big idea, really. Competition is meant to be the natural regulator.
How so?
Well, competition for customers should stop companies from charging way too much or making terrible products because you just go to their rival.
Okay.
And just as importantly, competition for the best workers should keep wages fair. If I pay my employees terribly,
Someone else will hire them away.
theoretically, yes, that's the ideal.
And that model, it really seemed to flourish in the U.S., didn't it? Especially that period after World War II. People call it a golden age.
It really was historically unique. You had this massive growing labor pool in the U.S., especially with more women entering the workforce.
Right.
And huge amounts of disposable income domestically. Remember, much of the rest of the industrialized world was still rebuilding after the war.
So America was kind of the only game in town, economically speaking.
In many ways, yeah. You had this amazing domestic consumerism. It creates this perfect feedback loop. Americans made the stuff, sold the stuff, and bought the stuff.
That built the middle class.
Absolutely. That period of strong domestic spending, that's what really created that robust American middle class we think of.
But as you said, the system needs constant escalating profit growth. That's the engine. So to keep feeding that need, companies had to find ways to make things even cheaper. And this, I think, is where we hit a major turning point in this whole story.
It really is. It's the shift towards globalization. You had these trade agreements like J, and then the WTO being set up.
Making international trade easier.
Much smoother, yeah. And American companies suddenly realized they could achieve massive cost savings. They saw they could just move the factories, move the means of production to developing countries.
Where labor was cheaper.
Much cheaper.
Right.
Often with far fewer protections for workers or the environment. They could basically trade, relatively well-paid union workers in the U.S. for low-wage labor overseas.
Cut their labor costs way down, ship the finished goods back here, and still sell them for a good price.
Exactly. And what this really meant for the American workforce was a kind of systemic loss of leverage. These huge trade deficits that followed started dragging down wage growth, especially for U.S. workers who didn't have a college degree.
The data on this is Well, it's pretty startling when you look at it.
It's maybe one of the most shocking pieces of this puzzle.
Yeah, think about the period from, say, 1979 up to the mid-2010s. For workers without a college degree, their wages, adjusted for inflation, they actually shrank.
Shrank, not just stayed flat.
No, they went down by about 5 or 6%.
Wow, okay, but during that exact same time, what happened to the cost of living? Essentials, housing, food, gas.
Skyrocketed, up by almost 226%.
Okay, so let that sink in. Your actual earning power is going down relative to inflation.
Mm-hmm.
While the cost of nearly everything you need to buy is more than doubling, almost tripling. That's not just stagnation. That's actively going backwards for a huge chunk of the population.
It puts immense pressure on families, doesn't it? You can see why people feel squeezed.
Absolutely. And it explains why, all the political talk about bringing manufacturing jobs back, it often feels disconnected from the economic reality.
Yeah, the analysis we looked at suggests the U.S. is now structurally kind of locked in as a post-industrial capitalist society. Those factories aren't just coming back easily.
Not without massive changes. Either the wealthiest accept much lower returns, or you need huge legislative shifts, which seems unlikely. Or companies risk losing customers if prices suddenly jump to cover higher U.S. wages.
Right. So if wages are falling behind like that while costs are exploding, how do people cope? How do they maintain their standard of living or even just afford the necessities?
Well, there's really only one way for many people: debt.
Oh.
And this brings us right to how those traditional markers of the American dream start to erode.
Okay, let's talk about that debt anchor. The average consumer debt figures are just crushing, almost $90,000 per person. That's credit cards, car loans, mortgages, student debt.
It's staggering. And education, which, was always pitched as the way up, the way out of financial struggle.
The great equalizer.
Yeah. It's actually become a major source of this debt spiral for millions. There's a real irony there.
Especially when you look at professions like teaching.
Exactly. Teachers in many states, they take on debt for their degrees, but then find themselves earning, adjusted for inflation, maybe 5% less than teachers did 10 years ago. The investment isn't paying off. It's burying them.
And that debt load, it has knock-on effects, particularly for things like buying a house, right?
Yeah.
Which is key to building wealth over generations.
Huge effects. The housing figures are really eye-opening. In 2024, only about 24% of home sales were to first-time buyers.
24%? That sounds low.
It is. It's down by half, 50%, compared to 2010.
Wow.
So that ability to get on the property ladder, to start building equity, it's being pushed further and further out. The average age for a first-time buyer is now 38.
38? That's way older than it used to be.
It's a full decade older than the historical norm. And think about affordability. If you were earning, say, $50,000 a year in early 2025, your chances of finding a home listing you could actually afford, less than 9%.
So for over 90% of people in that income bracket, homeownership is basically off the table.
Pretty much. When that primary way most families build wealth over time is locked off for the vast majority of the working and middle class, achieving stability becomes incredibly difficult.
And the worst outcome, the most tragic consequence of this whole economic pressure cooker.
Right.
We see it on our streets, don't we?
We do. Homelessness has jumped significantly, up about 18% since 2024.
That translates to
Around 771,000 people, and that includes 150,000 children without a stable home. It suggests the basic safety net just isn't holding under the strain of stagnant wages and soaring costs.
it's heartbreaking. And even for people who manage to keep a roof over their heads, what about the end game, retirement?
That picture is also looking pretty bleak for a lot of people. We're seeing almost 11 million Americans over 65 still working. That's 1 in 5.
Still working past traditional retirement age.
Yeah, often because they have to. And maybe even more worrying, nearly half, almost 50% of people between 55 and 66 have zero retirement savings, nothing set aside.
Zero. So the system is basically demanding they work until they physically can't anymore.
It seems that way for many. Perpetual labor just to survive.
You know, all these trends, they sound disturbingly familiar. It really does echo what some people call the new Gilded Age. The analysis points to this unsettling parallel with the Roaring '20s.
It's a striking comparison. Think back to the 1920s. Corporate profits were booming, right? Up something like 62%.
Huge gains.
But that wealth wasn't trickling down to the workers. Wages were largely flat. And that massive inequality peaked right before the crash.
Right. What was the figure then?
By 1929, the top 0.1%, tiny fraction, held about 34% of the entire nation's wealth. That was the same amount as the entire bottom 42% combined.
That level of concentration is hard to even grasp. And the functional problem that led to the crash was?
Pretty simple, actually. The workers, the consumers who were supposed to buy all the products the factories were churning out, they just ran out of money.
They didn't have the purchasing power.
Exactly. Not enough collective purchasing power to keep the economic engine running.
And that led directly to the Great Depression.
So that historical pattern, huge profits at the top, stagnant wages below, leading to a lack of consumer demand, that's what makes the current situation feel so precarious.
Precisely. Look at what happened during the pandemic lockdowns. While millions lost jobs, the combined wealth of U.S. billionaires actually increased by over $2 trillion between March 2020 and October 2021.
An incredible divergence. And the concentration of capital now is just extreme. The richest 1% own half of all U.S. stocks and mutual funds.
Half? Wow, that's up significantly.
It is. It was around 40% back in 2002.
Ah.
So when you hear about the stock market booming, you have to remember who is actually benefiting from that boom. It's heavily concentrated.
Okay, so after the Great Depression, the response was the New Deal, based on Keynesian ideas, right? Trying to get money circulating, ensuring workers had decent wages so they could buy things.
Right, the focus was on demand. Good wages fuel consumption, which fuels production.
But it seems like modern corporations have found ways around that model, ways to maintain high profits without necessarily paying high wages or providing that old-school job security.
The analysis points to two main sort of structural workarounds.
What's the first one?
The gig economy. Platforms for ride-sharing, delivery, freelance work.
Right.
These often operate in a bit of a legal gray area. They classify their workers as independent contractors, not employees.
So they avoid things like minimum wage laws, benefits, unemployment insurance.
Exactly. It completely sidesteps a lot of traditional labor regulations and costs. And it's huge. Estimates suggest around 64 million Americans, maybe 38% of the workforce, were doing freelance or gig work in 2023.
So people trade stability for flexibility, but the company basically offloads all the risk and responsibility.
That's the dynamic, yeah. It fundamentally changes the relationship between the worker and the company providing the work.
Okay, so that's one workaround. What's the second?
The second is maybe more insidious. It's actively undermining the very thing that's supposed to regulate the system.
Yeah.
Competition.
How?
Through what you might call crony capitalism. Massive corporate lobbying, for instance.
Spending money to influence laws.
Billions.
Yeah.
Something like $4.4 billion spent just in 2024 to influence Congress. The goal is often to keep tax loopholes open, ensure regulations are favorable, or even secure taxpayer bailouts if things go wrong.
So they're using political influence to protect profits instead of competing purely in the marketplace.
You could certainly argue that. And alongside lobbying, they actively work to crush or absorb rivals through aggressive mergers and acquisitions, M&A.
Buying up the competition.
Exactly. That's why you see major antitrust complaints and investigations targeting giants like Google, Amazon, Apple, Visa, even Live Nation Ticketmaster.
Because they're becoming monopolies or close to it?
They're accused of using their market power to eliminate competition, so eventually you, the consumer, or other businesses have fewer choices. It removes that competitive safeguard the whole capitalist theory relies on.
Okay, so when you put all these pieces together, the flat wages, the debt, the housing crisis, the erosion of retirement, this massive wealth concentration, the gig economy loopholes, the lobbying, the crushing of competition, it paints a pretty concerning picture.
It really does. These trends, taken together, seem to point towards something more fundamental than just a typical economic slowdown or cycle.
So let's try and synthesize this. We started by asking if the American dream was becoming a nightmare, and the evidence we've discussed suggests that the core structures that were supposed to regulate capitalism, things like fair labor practices and robust competition, are being systematically worn down.
Yeah, eroded by this unchecked consolidation of wealth at the top, and, frankly, by legislative and regulatory loopholes that benefit the few.
Where does this potentially lead?
Well, if you connect the dots and look at the bigger picture, some analyses suggest these trends point towards something potentially quite dystopian, sometimes called techno-feudalism.
Techno-feudalism, what does that mean?
It's the idea that power isn't just about owning factories anymore, like old-school capital. It's shifting towards controlling the massive digital platforms, the data networks, the algorithms that run our lives.
So like digital fiefdoms.
Kind of. The individuals or corporations who control these digital infrastructures could potentially consolidate immense power, leading to a collapse in personal wealth and maybe even freedoms for the majority of people who just become users or gig workers within those systems.
That's a really stark and powerful prognosis. It suggests the system isn't just malfunctioning, but actively pushing the middle and working classes towards a breaking point.
A potentially catastrophic one.
Yeah,
Which, brings us back to that historical parallel with the Great Depression. It raises a really important question for all of us, I think.
which is.
If we see the same conditions emerging, specifically a lack of broad consumer purchasing power caused by flat wages happening at the same time as high corporate profits, high prices, maybe even overproduction in some areas, which is arguably the scenario we're looking at now. Are we just watching the middle phase of a domino chain that inevitably leads to a major systemic breakdown? Or is there still time? Is comprehensive reform actually achievable before the whole structure potentially collapses?